live from our studio in New York City. I'm Julie Hyman. That's Josh Lipton. This is Yahoo Finance Live. Here's what we're watching this afternoon. The aftershocks from Sam Altman's ouster from OpenAI. They keep on coming. And now the future of OpenAI is at risk and in question. Nearly all of the company's employees are threatened to leave and follow Altman to Microsoft if the board does not resign. We're following the latest developments of this roller coaster ride, and we'll bring you the updates.
Citi making its latest round of cuts. Roughly 300 senior manager roles have been eliminated. Later this hour, the roadmap for future cuts as CEO Jane Fraser looks to simplify the big bank.
And today marks the first anniversary of Bob Iger's return to Disney. The stock is down 2% in that time and still faces hurdles from streaming to parks. We'll hear from one analyst on how he thinks the company is faring in its turnaround efforts. Let's get you up to speed on the market action right now. And we are seeing stocks rally on the day here, being led by technology and communications services. Right now, we've got the Nasdaq leading up about 1.2% here, the S&P up about 0.8%, and the Dow up about 244 points, let's call it about 0.7%. The one group that is lagging today is utilities, but it does seem like, Josh, that this is linked up with all of the excitement and questions and whatever is going on with OpenAI and Microsoft.
Yeah, that is the story of the day right now. I would just mention, though, too, we did see that sale of 20-year treasuries, and that's being characterized as kind of fairly strong demand. So that's another wrinkle. I mean, obviously, traders, investors have been laser focused on those treasury sales. I'm just looking at the 10-year down to, it looks like 4.42. Wasn't so long ago, it was 5%. So
yeah, definitely some relief being felt on that front, I'm sure.
That's it. And moving, as Julie just alluded to, there, our top story of the day certainly has to be Microsoft hiring Sam Altman to lead a new AI research team after he was pushed out as CEO of OpenAI. Shares of Microsoft falling in response to Altman's ousting on Friday, but are up today, hitting a record high. It's after Microsoft announcing he's joining the tech giant. Yahoo Finance's Josh Schaefer is here with us to talk about some of the reaction across Wall Street. Josh, what are you hearing?
Yeah, Josh, overall, people are pretty excited about Microsoft, the prospect of Microsoft getting Sam Altman, right? If you wanted to make any sort of comparison to maybe sports or something like that in the world of AI, Sam Altman's the star player, right? And you went from being invested in him and having exposure to him in OpenAI to him getting ousted from OpenAI, people concerned, wow, Microsoft now has no access to probably the best brain in AI, to actually he's going to come start a team with us, and he's going to be able to recruit some of his players to come there and build out a big team. And I think that's a lot of what the street's excited about here, is the prospect of who would want to work with Altman on this team. But I do want to highlight one quote from Evercore that I thought sort of summed it up well. They said, when taking a long-term view, hiring Altman and team might end up being a better outcome versus the prior status quo. Overall, saying that they think the long-term opportunity around Gen AI for Microsoft trumps any near-term risks associated with the OpenAI disruption, because that's the other important thing to highlight here, guys, is, of course, Microsoft had that $10 billion investment in OpenAI. So how OpenAI performs, even if Microsoft gets Sam Altman, they still want OpenAI to do well, right?
Well, and that even if turns out to be rather important, doesn't it? Because, we've been whipsawed, by following all these developments over the weekend. So we were on air Friday when the news came that the board was removing him, right? Then there was reporting late Friday, he said he's going to start another company, right? And then there was reporting that the board of OpenAI wanted him back. No, actually, they don't want him back. Now Microsoft is hiring him. OpenAI employees, the majority of them have signed a letter saying that they don't like what went down. But now The Verge is saying Altman's still trying to get back to OpenAI. So, good luck if you're an investor trying to figure out what this means when you don't even know what's happening from moment to moment.
Well, maybe a little bit of patience for once, right? For all of us might help here. I know it's
patience. Come on.
Yeah, there's a stock trading, right? But I mean, if we take a little bit of a step back, who's everyone following there, Julie? Like I said off the top, Sam Altman, right? Even the workers of OpenAI. My guess is a lot of them don't sign that letter, or part of what they were saying in the letter essentially was, if Altman comes back and the board is gone, we want to work for OpenAI. If not, we want to go work with Sam at Microsoft.
Yeah.
It's all about where Sam ends up and where he's going to be building is what it seems like.
I mean, I struggle with thinking about any other story like this as long as I've been reporting in business news. I've just never seen this kind. First of all, the very idea, as Julie said, we were on air when this happened, that you would fire Sam Altman, a well-known, well-respected guy in Silicon Valley, even before OpenAI obviously had made his mark molding and leading Y Combinator to be the powerhouse that it is. And now, as you say, you're sort of stuck in limbo. He's either at Microsoft, and I totally understand why, listen, the teams at Evercore, RBC were excited because you're bringing on that kind of talent, that kind of experience and insight and Rolodex. But now, if the reports are accurate and hundreds of OpenAI employees are saying, listen, we're ready to jump ship with this guy, you're just sort of stuck in limbo here. That is an enormous amount of pressure on OpenAI's board.
Yeah, like you said, it's eye-popping to me just to see this in business news that one person can be driving basically how Microsoft is making decisions, right? And it's not Satya Nadella.
Well, although he, to your point, and a lot of the notes gave a lot of props to Satya Nadella.
He clearly made some deals here, and he made some good deals.
Well,
if it holds.
If it holds is really the question, but it also highlights that he was very dependent on a deal with an outside, entity that was much more in flux, perhaps, than he realized. I mean, Matt Levine of Bloomberg has a great column today, as he typically does on this, where he looks at the structure of OpenAI, which is a nonprofit entity controlling a for-profit entity, but did it really control it? Or does Microsoft, which has a profit motive, while OpenAI has a humanity motive, was it really pulling the strings? And I think we still don't really know.
Patience.
Oh, Josh Schaefer, thanks so much. I like that we've got a color palette going today,
Of course,
guys.
nice, yeah.
Let's continue this discussion because the future of OpenAI is uncertain after its board ousted founder and CEO Sam Altman. Now the employees are threatening to jump ship to Microsoft. Our next guest is Altman's future at Microsoft has some real upside for the tech giant. With us now is Fred Havemeyer. He is Macquarie lead software equity research analyst. Fred, you just heard us talking about this. Like, we don't even know if one moment to the next, if indeed Altman is going to end up at Microsoft. As somebody who's trying to analyze this company and its future profits, just give us, first of all, a little color on how you're following all this and sort of analyzing it in real time.
Well, following and analyzing in real time is actually very accurate because I think I was publishing at around 4 a.m. last night when the news was coming out that Microsoft was hiring Sam Altman as CEO of a new AI venture, as Satya Nadella published on X and or Twitter. So the way that I'm thinking about it is that right now, I think Satya has essentially pulled off a coup that I have not seen the likes of before in the tech market. He's pulled in and brought in Sam Altman, CEO of, as we've all been talking about here, CEO of OpenAI and one of the clear visionaries in the entire generative AI landscape right now. And also, of course, someone who has been leading the commercialization push within OpenAI. And following that, we've heard the news that now the majority of engineers at OpenAI are considering leaving the company and potentially moving over to Microsoft, which appears to be ready to welcome them with open arms. So I think in the range of outcomes here, we see either an opportunity where Microsoft ends up consolidating and essentially acquiring OpenAI without actually having to tender any sort of acquisition under the present scenario where Sam Altman is running as CEO this own AI venture within Microsoft. In a second scenario, even if we go a route where Sam Altman returns to OpenAI, I think Microsoft would continue to benefit. We would see continued commercialization, likely of models, and an emphasis on shipping product, which, if you recall back with the Microsoft partnership, OpenAI has delivered to Microsoft a licensing agreement that gives Microsoft access to every large language model and AI model that OpenAI produces up to what the board defines as artificial general intelligence. So it's a scenario where I think Satya played everything very well. I think that overall just reinforces our view that Microsoft is the top pick in the generative AI landscape for us.
But Fred, let me ask you this though. Microsoft at the same time, it has this big stake in OpenAI, right? And it was valued, I think, Fred, at something like $86 billion. But now we're in this state, we don't know what OpenAI is worth. How should investors, how are financial analysts thinking about that?
I think when we consider what has that partnership to begin with, part of it has been cash and part of it has been compute credits on Azure. So if we think about this partnership in general, it's in one that's benefited Microsoft also through its commercialization of OpenAI, such that if we look at the last quarter, we estimated that Microsoft was operating in Azure at about a $1.6 billion run rate for its generative AI related services. So with the amount of revenue that Microsoft is generating through existing Copilot solutions, in addition to the commercialization of things like OpenAI hosted on Azure through this licensing agreement, we think there's still tremendous value here. Whether or not OpenAI remains an independent, commercialized, and really border-pushing tech company, or whether this ultimately is internalized within Microsoft as its own AI venture, we continue to think that they win.
And the title of your note on this was, "If you come at the king, you best not miss," referring to Sam Altman. What is it about this guy, Fred, that is so magical, seemingly, that nobody wants him to leave, everybody wants him? Is he really so bound up here in the future of AI?
So I think when considering what Sam Altman brings to the table, it's been a consistent vision towards what the future could be in terms of developing, commercializing generative AI. I think Sam Altman has been shown to just have a very keen business mind that is able to synthesize just very complex technology and topics and convey it and do the storytelling in a way that makes sense to both investors as well as those teams that he is building. And I think the team building part is actually one of the most critical aspects to discuss here. One of the reasons that the engineers and teams at OpenAI appear so ready to join him is from just what we've been hearing, the general loyalty that he inspires among the teams that he's been building, cultivating, and also pushing in many ways to produce the best technology possible. I think that's been one consistent refrain, is that Sam Altman always tends to push those that he's working with to continue that acceleration towards developing something new, disrupting something new, and delivering just category-defining products.
And Fred, talking about Microsoft as well, listen, you're a bull, you got to buy on the name. It has surged this year, Fred, so we're up about 60% here. What are the catalysts ahead, Fred, that you think moves Microsoft higher? And do you, even with that surge, you obviously still think valuation's attractive?
Oh, I definitely think valuation is attractive here. So the way I'm thinking about Microsoft in general is when I look at the opportunity ahead in the generative AI landscape, I tend to think that we are just at the very early stages of what this market might offer. So even though I quoted a number about $1.6 billion of annualized revenue in Azure related to AI services, I would note that that's up, we estimate, about almost 3 times quarter over quarter on a run rate basis. So this is, despite being early stages, something that's growing very quickly and something that's, as Microsoft called out, driving growth for Azure through the balance of this year. And we think that is something that is at this very early stage, with enterprises still beginning to experiment with how to bring generative AI into their companies, something that we're very excited about and we think will continue to drive long-term momentum in this stock.
Fred, I got to ask what this means for everybody else, right? Has the picture changed? And I know you don't cover it directly, but has the picture changed over the weekend for an Alphabet or for a Meta, or for that matter, for something like a Salesforce, which you do cover? Or is this, because it's sort of still Microsoft, it doesn't really change the equation for others?
So I think that what we may see, and this will depend, of course, on where things shake out, because I think all of us have seen the headlines are moving in real time as we speak. But I think it will depend ultimately on where the talent at OpenAI ends up. I think if the talent remains consolidated within OpenAI or perhaps within Microsoft, we may see a continuation of the just commercialization of generative AI technologies within Microsoft that's similar to the present environment. I think generally there's likely a number of companies that are thinking about their counterparty risk right now and what things might look like if suddenly most engineers at OpenAI were to leave. We took a look at it through the example of ChatGPT. Can that, for example, be sustained on a skeleton shift of engineers potentially keeping that up and running? So I think in general, it will depend on where the OpenAI engineers remain. Likely, if Microsoft is able to build out its own expertise with, for example, hiring OpenAI engineers, then I think Google would have a potentially very difficult competitive landscape in front of it, where its own DeepMind organization would now face not just OpenAI, but the consolidated OpenAI within Microsoft that unlocks the entire Microsoft balance sheet, potentially for future innovation and development built on top of Azure. I think if we think more broadly in the landscape, Meta has had this open source large language model approach, and it's unlikely things would change around that strategy there. But in terms of the giants that are commercializing, I think that it could be very beneficial for Microsoft. Once again, just it depends on whether or not the engineers end up in Microsoft, OpenAI, or elsewhere.
All right.
We think
that's the question we're all going to keep watching, Fred. Fred Havemeyer from Macquarie, thank you so much for your time and your insight today, Fred. That was great.
Thank you.
All right, now let's take a look at some of today's top trending tickers. We're going to start with ARM here. They are rising after Wells Fargo initiates coverage on the stock with an overweight. So overweight equivalent there, of course, Julie, of a buy. Their target, it looks like, goes to 70. It's trading right now just below 59. Remember, of course, they IPO'd at around 51. They argue that ARM's top line growth and margins should benefit from higher royalty rates. ARM charges on some of that newer generation technology they got.
Right, and they're also talking about what they see are captive chip designs, and indeed we've gotten headlines more recently about other companies using ARM architecture in order to build their own chips, but they're still using the ARM architecture. They also talk about some of the challenges that could be beneficial for them as well. China developing a domestic chip industry, again, if they're using ARM architecture in some cases. And they're also talking about a more holistic compute market opportunity for the company. So just overall, seeing them as a winner in the semiconductor market.
Yeah, it's interesting because you talk to analysts about, chips and their exposure to China. We know some names, for example, have been a bit more in the crosshairs, like Nvidia. When you talk to ARM bulls, they actually said that was one perhaps tailwind for ARM. They didn't think they were in the crosshairs of Beijing like some others.
Yeah, interesting stuff. And it's underperformed some of the other chip names this year. I mean, when you look at something like an Nvidia that's up, 200% or something? Yep. This stock is only up about 15%, so it's been an underperformer on that basis. Let's talk Chegg, shall we? The company getting hit by a downgrade by Morgan Stanley. The firm turning bearish on the stock as it cites rising competition and concerns about slowing web traffic growth. The stock is down about 7.5% today, and Chegg has had a wild ride, to say the least. The stock is down sharply year to date. There's a lot of concerns about sort of ChatGPT style educational aids, the effect that's going to have on the company. But it has bounced, even though on that chart, it's a really little bounce, but it's enough of a bounce for Morgan Stanley to say that that recent bounce is the reason that now is the timing behind this downgrade.
Yeah, they're basically telling clients, listen, we see weaker trends in October. They say here specifically call out web traffic, app download data trends weakened in October. And then to your point, Julie, they also see, listen, longer term here, the intensifying impact from generative AI, that could be a real issue here as students maybe who have allegiance or know Chegg very well, they say as those kids graduate, you got a problem potentially.
Yeah, this is it's such an interesting and sort of depressing, maybe kind of question, right, as to how important generative AI and ChatGPT specifically is going to be to the education system and how much kids are going to be using it.
Oh, yeah.
And I think institutes of higher learning in particular are really trying to grapple with this and sort of incorporate it, right, acknowledge that it's happening, which is what Chegg has also tried to do. But investors are not seeing it as being very successful.
It could make homework look a lot differently in the future, for sure. For sure. All right, last year, Boeing getting a lift after Deutsche Bank upgrades the stock to a buy. The upgrade comes as plane deliveries are beginning to accelerate. So they go to buy. They say aircraft deliveries starting to move in the right direction. Credible case, they argue. That's true. Better performance can be maintained. They think maybe that should mean positive inflection, it looks like, in free cash flow revisions.
Yeah, that's really the key here, is that the free cash flow is one of the main numbers to watch for Boeing. As we know, Boeing has really suffered a number of setbacks, some of it by its own design or own fault, if you will. It also had some issues with that supplier, Spirit Aerosystems, that then caused some issues for one of its planes. So it now seems like maybe Boeing is having a pivot point. It just got a bunch of orders, overtook Airbus at the most recent Dubai Air Show. And so, that seems to be a little bit of wind in its sails, if you will, that then led to this inflection call from Deutsche Bank.
We saw some better, some good headlines out of that show. Stock is up about 15% this month, so investors have been paying attention for sure.
Yes, they have. We're just getting started here on Yahoo Finance Live. Coming up, Citi CEO Jane Fraser announcing the company's next set of layoffs today as it looks to restructure. We'll have more details for you later in the show. And it has been 1 year since Bob Iger came back to Disney. We'll talk about the problems the company faces since the leadership shakeup. Also, Black Friday for streaming. Max offering a steep discount for its services. We'll tell you how much you'll pay. All that and more when Yahoo Finance returns. Bond yields trading lower today after the Treasury Department saw strong demand at its issue auction. Yahoo Finance's Jared Blickery has the story here. As we know, that's been the tail wagging the dog in the equity market as well.
Yes, it's not normally the case throughout history that these bond auctions actually move stocks, but that's what's been happening recently, especially after what was nearly a failed auction just a couple weeks ago in the 30-year. So today we're tracking the 20-year bond, but we're actually looking at what happened, the reaction, in other words, in the 10-year T-note yield, and it was a pretty big drop. At 1 p.m., that's when the auction was conducted, and then we got a big drop after that. Net, it's down about 2 basis points today. Now, you compare this to what happened, and I'm going to put some candlesticks here. Compare this to what happened on November 9th. That's when we got this big up candle in yields. That was a different situation. The 30-year had very poor demand, and we saw yields shoot up after that. And at the same time, we saw the stock market take a little bit of a dive, but that is not what happened today. Here's the Dow Jones Industrial Average, and this is the intraday price action. And you can see we got this nice spike up right there. So bottom line is, if you're trading stocks, you got to, at least on a day trading basis, you got to be worried about what the bond market is doing, especially on these big auction days. Now, this was the biggest auction of the week. We do have some other ones. In terms of dollar amount, we have some very short-term bill auctions. Those are the biggest, but they typically don't move equities. At a 20-year bond, we just had that. And then tomorrow, we have the two-year floating rate note and also 10-year tips. Those are lesser auctions, and I wouldn't expect as much movement, but stay tuned. Check out your feed on 11 a.m. and 12 p.m. as well to see if that does come to fruition. But I'm looking ahead to next week. I'm looking for the 2s, the 5s, and the 7s to be auctioned 1 p.m. on Monday and 1 p.m. on Tuesday. Those are going to be the big draws, and I'll report back to see if anything we can find out from, or to see if we found anything out from that. I just want to close here. Why does the bond market make so much noise here for equities? We're finally at that stage in the business cycle where the Fed appears to be on pause. In fact, that is so consensus and opinion. The danger is that it's not actually what happens, but that's a tale from another day. So without the highest rates in the world that are pushing higher, there's less of an impetus for all this money around the world to slosh in, bid up the dollars, bid up rates, and then depress the stocks. So what we're seeing instead is money come in, and it's not a zero-sum game here. Bottom line, I would say in the 10-year, let's take a look at the price action year to date, do a little bit of a technical analysis. We managed to drop from 5% to 4.5%, and then we dropped just below, and it looks like we have tested this support line. If I'm anything at technical analysis over the short term, it looks like we're going to be stair-stepping lower. That means the pain trade, if it happens, is a strong shoot above the 4.5% level. Guys.
Jared Blickery, thank you, my friend. The Fed in focus on Wall Street. Nearly 30% of interest rate traders are pricing in the Fed's first rate cut in March. It's according to the CME FedWatch tool. But Richmond Fed President Tom Barkin saying today he sees inflation being stubborn. And he's advocating for a higher for longer stance on rates. We'll get more insight into the Fed's thoughts tomorrow when we get the minutes from the last meeting. For more on this, we turn to Megan Horniman, Verdant's Capital Advisors Chief Investment Officer. So Megan, thank you for joining us. Let's get your take on this. When do you think, Megan, the Fed starts cutting?
I think March is way too optimistic. I think you're looking in a second half of next year, early 2025. And I think you said it, the inflation now is going to be much more difficult to get down to that 2% level where they want to be. It was pretty easy when we cleared up the supply chains and moving past the pandemic to get some of that goods type of inflation taken out of the equation. But now you have that sticky inflation. The three areas that we're focusing on is housing, services, and then wage inflation. And all of these three things are still growing on an annual basis, well above what the Fed wants.
And so then what, Megan? I mean, because the market believes that the Fed is done, and the Fed has done nothing to dissuade the market from that belief. But if inflation isn't coming down, is the Fed actually done?
I actually think the opposite. I don't know why everyone's getting so optimistic on the fact that they can come in and cut rates. They've told us they can't. They've told us they're going to remain vigilant higher for longer. They haven't done anything to really take a hawkish view out of this. So I think we're back to the same situation we were last year at this time. If you remember, rate cuts were expected in the very early part of this year at this time last year. Didn't materialize, and it's proven that inflation has just been more difficult to get under control. I think we're in the right trajectory for inflation, but I think getting down to that 2% level is going to take more time. And unfortunately, it's going to take some pain in the economy for us to get there.
And so, Megan, listen, if the Fed's higher for longer, we don't see cuts, at least in the near to intermediate term here, what does that mean for the equity market as we head into 2024, an election year, 12 months from now? Megan, do you see the SPX, the S&P 500, is it higher than we are here now?
I think by the end of next year, yes. But what I think is there's some, I guess you could say, recency bias with investors. First of all, they're very used to the Fed coming in and saving the day and cutting rates whenever there's any sign of economic weakness. That's not the case that I think going into next year. The Fed's going to have to remain higher for longer. And that's an environment that we're not used to seeing. Let's remember, from an equity standpoint, we're in a positive seasonal period right now as well. So I don't doubt that we can still have some upside here. But things are going to get really challenging as we go into next year. Not only is the economic situation very unclear, but you also have earnings expectations for next year and 2025 that we think are just too optimistic. They're going to have to come down. So when you get a realization that rates are higher for longer, you could see PE multiples contract, and then the earnings component of that as well is something that I think is going to come down.
So what do you do then, Megan, in terms of positioning? Do you get more defensive? Because some of those traditionally defensive groups also happen to be interest rate sensitive.
Mm-hmm. Yeah, so it's you have to be a little bit, I guess you could say, careful. There's, active trading here, active portfolio management. This is the best time to do that. Right now, from an overall portfolio positioning, we're neutral on our global equities. We have been reducing an overweight throughout this year because mainly the fact that we think investors are too optimistic on what the Fed can do. So we're sitting neutral, and we're not underweight because, to be honest, we are either, whether the last hike was in July or they have to go one more time, we are towards the end of this, the aggressive part of that rate hike. So they're behind us. So we want to stay neutral. From a fixed income perspective, we don't want to go out super long yet. There's a lot of complexities in the long end of the curve. We've talked about it earlier with the auctions as well, that these are something, today's was good, but this has been really market moving the past few weeks when it comes to the auction perspective. And then, when we look, we want to have cash. I mean, cash is a good thing to have in this environment. You can keep that short duration, earn some nice income here at this very short end of the curve, and then have that cash to be able to put to work when you do get that weakness and volatility. And we do expect that in the first half of next year.
Megan, good to see you. Thanks so much for spending a little time with us today. Megan Horniman.
Thank you.
Thanks. Citi CEO Jane Fraser announcing the company's next set of layoffs today as the company looks to restructure. We'll have more details for you on the other side of the break.
Citigroup making its latest round of job cuts. 300 senior managers are out. David Hollerith is here with the details. David.
Josh, so the bank issued a statement Monday morning saying the actions we're taking to reorganize the firm involve some difficult, consequential decisions, but we believe they are the right steps. So this round of layoffs is part of a sweeping reorganization effort that CEO Jane Fraser laid out in September, which aims to ultimately simplify the bank to improve profitability. Now, Citi has maintained about 240,000 employees for the past 4 quarters. And this particular reduction, as you pointed out, focuses on eliminating middle management layers. So according to Bloomberg, that comes into roughly 300 senior manager roles, which translates to about a 10% reduction at that level. The reduction of those managers is also seen to cause ripples of more layoffs across the organization for as much as 10% in some parts of the organization. Now, this being that some people below the people who were laid off have lost their reports and in such a way their direct business line. In an internal memo, Citi's Fraser said to employees today, "No question, these are the proverbial hard yards." So in parallel to this, the bank has also been selling off parts of its consumer business across the world. This has been in regions including Australia, Bahrain, Vietnam, and most recently, which was announced over the weekend, Indonesia. So some of today's cuts can be read as adjustments in support staff as a result of Citi shrinking its international consumer businesses. CFO Mark Mason is going to say more about this when he speaks at a Goldman Sachs conference at the beginning of December. But all told, the actual data of what these layoffs will mean, we won't know until sometime early next year.
Well, David, in terms of what they'll mean, we do know sort of, maybe a little bit, what Jane Fraser is aiming for here, right? So can you put this in context for us here, what this, in terms of the bigger plan for the bank?
Sure, yeah. So I think it's fair to say since around the late, or I guess you would say early 2010s, Citi has struggled with profitability, and they've had a number of regulatory issues too. And in general, the bank is very complicated, and it's known to have a really broad international presence. So CEOs in the past have tried different things to make Citi a little bit more efficient, a little bit more profitable. And since Fraser's come in, really the effort has been about simplifying it and getting out of some of these international consumer businesses, which are not as profitable. She's also splitting up sort of the 2 broad divisions of the bank into 5 different divisions. Each of the top of those divisions will report directly to her. So in a way, it's a way to reimagine Citi that sort of shows profitability more transparently. And ideally, this is something that shareholders will want.
We shall see. The stock's not doing much today, but I guess over the longer term will be the real measure of whether they like it or not. David Hollerith, thanks a lot. Well, investors can look forward to another batch of retail earnings on Tuesday. And then, of course, we've got Black Friday and Cyber Monday coming and the whole holiday season. According to a new Deloitte survey, spending is projected to increase 13% from last year, reaching new highs. Meanwhile, retailers remaining cautious on future consumer spending amid economic uncertainty. Here with what's ahead for retail, we've got Stacey Widlitz, founder and chief international store hunter of SW Retail Advisors. Stacey, it's great to see you. Thank you for being here. So give us the big picture, first of all, going into this holiday season, given what we've heard from the retailers so far, where they're definitely sounding a little bit cautious, but given also some of the survey results that show higher spending's coming.
Absolutely. And we've heard different stories from different retailers. Obviously, consumers are spending on necessities. We're talking about disinflation, and that's great. But the bottom line is food costs are up 20% on a 2-year basis. And that's not declining. That's just stagnating. So the consumer is still feeling it and still spending on their basics. And I think you're going to see a lot of that this holiday season. And you're already seeing with The likes of Target and Walmart, they're pushing really hard on food and basics and health. I think the discretionary part of the business everybody said it's still weak. Home Depot, big ticket stuff is weak. Williams-Sonoma, their comps are down double digits on furniture. So there are issues out there. But, clearly these stocks have rallied, and particularly the underdog retail stocks have rallied 15 to 30%, some of them, because expectations are low, and also inventories are really lean, very clean going into holiday. So I think investors are giving a pass to the retailers for perhaps disappointing sales as long as their margins are intact.
And Stacey, so against that backdrop, we got Black Friday, Cyber Monday coming up here. What are you expecting there?
Oh yeah, my two favorite days of the year. So I think, again, as we see inventories super lean across the board going into these holidays, I think that we might see a little less promotions across the board than usual. You might see a little more up to 40% off rather than 40% off everything. But some retailers and some brands, as usual, take the opportunity to throw a 20% off to get the consumer interested, to get them in the store or online to buy other things. But again, I do think this year that mix shift toward necessities will continue.
Stacey, when you look at who's doing it right now, or maybe is it the intersection of doing it right and being in the right place in terms of just what consumers want right now? Is there an example or examples that you can think of?
Sure, there's several, but Walmart comes to mind. They reported comps that beat, and the stock traded down 8% because they've really had the wind at their back, because inflation that's been up high singles, food inflation, double digits over the past 2 years has been driving their comp naturally. So that's been a huge tailwind for them. That's coming to an end. And they talked about that. And at the same time, discretionary hasn't picked up yet. So I think the guys who had this food exposure, things are going to get tougher for them. And also you look at, the likes of Target. So their comps were down, their traffic continues to be down. Meanwhile, TJX, Walmart, traffic remains up. I think you want to own the players that still have the momentum in their traffic as we're going into a tougher environment, and you can't push pricing along to the consumer like these brands had. Don't forget, over the last couple of years, we had the likes of Kors and Tapestry, Coach, Ralph Lauren increased prices 20-30%. So the consumer's kind of had enough and is pushing back.
And let me ask you, Stacey, when we talk about the consumer, there's different types of consumers. Some analysts have said, listen, they think you're now looking at a real low-income consumer recession because they're looking at things like savings and credit quality deterioration. They're looking at confidence. Is that what you see?
Yes, and you see the lower end consumer, and they have been under pressure for the last couple of years because of inflation. And you're starting to see, of course, you're seeing auto loan rejections at highs that we haven't seen since 2013. Higher rates are pressuring everybody. Anybody who has run through their saving and is racking up credit card bills right now has a problem with those rates. So I think the consumer is definitely going into a period of, hey, I ran through all that money I kept during the COVID years, and looking on the other side, everything's more expensive. That's not coming down. So of course that low end, middle end consumer gets hit much harder. And by the way, Josh, you're seeing luxury come down as well. I mean, US luxury has turned negative months ago, and Europe was driven all by tourism, which now is starting to come down because people are not feeling safe traveling. So you're starting to hear that from Burberry, from LVMH. Gucci's numbers weren't great. So, it's really across the board.
At the same time, what's interesting, Stacey, right now about going into this slower period is that the retailers seem to be sort of in better shape, right? We've got inventories that are in much better shape, certainly, than they were. Does that mean, sometimes when you get one of these downturn periods, you have the sort of ailing retailers that limp off into the sunset. Do you think that's going to happen this time around, or do you think retail overall is sort of stronger going into this?
So I think the last round of store closings we saw before COVID was a washout, and I think we're in a good position now. Some stores will need to close. For example, the Gap, they'll need to close more stores. For several of their banners. There are other names there that also need to right size. Clearly, apparel is 40 to 50% online now, so they'll continue to be the slow walk away from the mall. But I think in general, retailers are smarter coming out of COVID. They're better with inventory management. They have more tools. They're better equipped to speak to their customer and figure out what they want and react, rather than just load up on inventory and cross your fingers. So I think we're in a good position, and it's comforting to see that we're going into holiday in a nice, tighter inventory position, where perhaps, we don't have to give everything away this holiday, and we start the new year off looking pretty lean with healthy margins.
All right, Stacey Widlitz, thank you so much for joining us today, Stacey.
Good to see you.
And coming up, Iger's one-year anniversary will tell you the problems plaguing Disney since Bob Iger's return to leadership. It's coming up next. Today marks 1 year since Bob Iger stunned Wall Street and returned to the top job at Disney. He's been working on a turnaround plan as he faces headwinds for the business, plus an activist fight. Joining us now is Jason Bazinet, Managing Director at Citigroup. So, Jason, thank you so much for joining us. Let's just start there. It's been 1 year. Jason, how do you grade Mr. Iger's performance so far? What do you think he's gotten right? What could he do better?
Well, if I had to give him a grade, I'd probably say a B. I think what's gone right is we've seen a very large restructuring, so $7.5 billion in total. We've seen streaming losses narrow by $1 billion. He's restored P&L responsibility to the studio heads. And those are all good things. I only give them a B because the streaming business is still generating losses. And we still have a lot of plates that are spinning. They're exploring strategic alternatives for ABC and the India assets. We still don't have resolution on whether the price they're going to pay when they acquire the 1/3 of Hulu. So there's still some TBDs out there.
Jason, it's Julie here. What is the probability that all of those TBDs end up as best case scenarios?
Well, look, I guess for the ABC sale and the India sale, the street doesn't have very lofty expectations. So assuming that the potential buyers are going to pay a reasonable price, I think that would be sort of, I would just call it noise that comes out of the ecosystem and gets the street focused on the good news, which is really around parks and streaming. Getting the streaming losses to break even, I would say the odds are actually quite good. It's sort of the mirror image of upsizing the restructuring, the $7.5 billion restructuring. And so I think that's very much on track. I think there is an outstanding question where the street's really giving no credit, and this really underpins the bull case, which is once the streaming business gets to break even, can they actually generate, Netflix type margins in the streaming business? That's still a long way off. And I think you have to give lower marks for that just because there's a lot of wood to chop between where we are now and where we're going. So it's shifting from a cost cutting story to get to break even to really sort of getting the right pricing for the streaming service to generate good margins.
And Jason, there's a lot of big personalities in this name. I don't just mean Bob Iger. Activist Nelson Peltz is involved too. He's back. He's seeking multiple board seats. Is that a negative for Disney shareholders, Jason? Is it a positive? How do you think through that dynamic?
Well, it's really interesting. Even when Peltz made his first run at Disney, one of the weird, I guess I would just call it dissonance, is we were not picking up massive dissatisfaction on the part of institutional investors with Disney. Normally when I see an activist come in, it's sort of the sort of last, it's like the missing piece of the puzzle that puts a capstone on just, a significant amount of shareholder frustration. It takes an activist to go in there and sort of stir things up. That was not the situation with Disney the last time Peltz was around. It's not the situation now. So I don't really view it as a positive or a negative. I think the honest answer is that there's a lot of dislocation going on in traditional media. It's going to take time to reorient any of these companies in a way to make money in a streaming world. And I think the buy side isn't frustrated with Mr. Iger or Disney's management team because they know it's going to take a while. And where we sit today, we don't have demonstrable evidence that the streaming business is going to be profitable. But Mr. Iger is doing all the right things, right? Getting rid of the non-core assets, at least getting the streaming business to break even. And so I just think he needs a little bit of breathing room, and the buy side understands that.
Even if he is going to get breathing room, we always ask everybody about the succession question, Jason, because listen, this is you could argue, he screwed this up last time, and that's why he had to come back. So how much time does he have to figure that out?
Well, 2 years is what I would say. He's got 2 years left on his contract.
Right.
I would say, the irony here is Disney's always had a little bit of difficulty with succession, right? And there was a carefully laid out plan that had to do with Jay Rizzullo that was running parks and Staggs that was the CFO, and they sort of swapped roles. And the whole idea was to make this a very smooth transition. And you're right, it all ended up going badly. And what that meant is Mr. Chapek came in as CEO. And, I would just say for Mr. Chapek, I would say that was another example where there was not institutional clamoring for Mr. Chapek to move on. I mean, the losses were there, but it was still it was more a function of the streaming losses than it was anything that Mr. Chapek did wrong. My 2 cents. And I just didn't hear a lot of upset investors, even when Mr. Chapek was CEO. But what Mr. Iger and the board are going to do in terms of succession, it's still a TBD. There is no clear plan as we sit here today.
Jason, do you think the new CFO there, Hugh Johnston, possible CEO at some point, could he be groomed for that role?
Possible. I think he's a little bit old. I mean, Disney used to have this role where once you hit 65, you had to retire. It was sort of mandatory retirement, and Mr. Iger sort of changed those rules. So I guess everything is a little bit in flux, but it would certainly be a pretty old gentleman to fix, take Mr. Iger's seat. So it wouldn't be my most likely choice.
Jason, always love having you on the show. Thank you so much for joining us today. That was Citi's Jason Bazinet.
You bet.
And coming up, closing bell on Wall Street, we're checking in on the latest market moves and the top trending tickers. Stay tuned.
We're coming up on the market close, so let's take a look back at some of the action that we've been seeing through the day. We're seeing the Nasdaq close near the highs of the session here, and it's been the leader all day. We've seen strength in technology, and of course that has had a lot to do with our story of the day, really our story of the last 72 hours, which has to do with OpenAI and Microsoft gaining 2% on the day.
Nice pop, although we're still kind of waiting to see how this all shakes out. We're in flux, Julie.
We are
in
in
flux.
uncertainty.
Yeah.
We don't know if Sam Altman is going to Microsoft, staying at OpenAI, doing something else entirely. It's still pretty unclear. We've had some cryptic tweets over the course of the day. Interesting, Nvidia also higher ahead of its earnings this week. It's really been seeing a run up into that period of time. I'm just going to take it. Let's just do a 1 month just for fun. 22% in the past month here. So obviously reflecting some optimism here. But everything else in tech, not everything else, but a lot of the other big movers in tech here, ARM Holdings, we talked about a call earlier.
Working off that
Meta
upgrade.
shares are, exactly. And then looking at some of the groups that are on the move here today, over on your side, we've got tech and communication services that are the two best performers here. Again, reflecting this enthusiasm for tech, which is probably also because of the lower rates that we're seeing today, in addition to all of the AI chatter.
We had that auction, which was characterized as fairly strong. So you saw the 10-year move lower. Those rates move lower, big tech can work.
Exactly. Yeah. And let's take a little bit of a deeper look at that by looking at the Nasdaq 100 specifically. We've already seen a couple of these movers in the form of Microsoft and Nvidia. But for those today who were saying, well, maybe Microsoft's gain is Alphabet's loss, that's not really reflected in the shares today. So it's not seen as this is a big loser because of what's going on with OpenAI.
Nice pop. And in fact, you could almost argue, listen, to the extent there's continued flux and uncertainty, maybe Alphabet and others are actually able to capitalize on it.
Yeah, maybe could step in. Again, Meta also higher on the day, Amazon and Apple also gaining as well. Not a lot of red on this NASDAQ 100 screen here today. And then we have the opening bell on this Monday. Of course, it's a holiday-shortened trading week because we got Thanksgiving coming up here in the U.S. on Thursday. So stocks going to be closed for that, and then a shortened trading session on Friday. So we are seeing the NASDAQ close again near the highs of the day here, up 1.1%. The S&P higher by about 0.75%. The Dow trading up by about 0.5%. And definitely some interesting superlatives to talk about today. Our Jared Blickery flagging the S&P 500 closing at its highest since August 1st. The Nasdaq Composite also closing at the highest since August 1st. I believe we have an all-time high in shares of Microsoft today on everything that's been going on. So that's expressing some strength as well. And we keep hearing over and over again from investors that this is a seasonally strong time for stocks. So that thus far has been borne out in what we've been seeing in shares today.
Yep. All right, let's look at a couple trending tickers today. One is Bayer. We have to talk about that because what you saw there, Julie, was actually not just a drop, but a historic drop. Different moving pieces here. For one, the company stopped the study for this important drug in the pipeline. Specifically, this was for an antithrombotic drug and was described in reports I was reading as really a potential blockbuster. So you can understand the street clearly very disappointed there. Now questions, what does growth look like for this company, not just the quarters, but the years ahead? Yeah,
exactly. And then the other big setback for Bayer that caused Bayer, depending on where you are, that had to do with Roundup, because this is, as it's through its acquisition of Monsanto, a product it acquired, and Roundup for years has been facing litigation, may yet face more litigation in the years to come. And there was another courtroom setback or defeat for the company regarding Roundup. So we'll continue to watch that. The company has set aside $16 billion for all the related lawsuits, but we'll see if there's more. On the drug side, Bristol Myers Squibb is developing a similar drug to what Bayer is developing, and so it too fell, but then it had an additional setback as well. The company saying that one of its drugs was halted by the FDA, I believe. So that also, that it's developing with a partner called 2seventy that I hadn't heard of before, but that is also falling on the day.
All right, one to watch. And moving on, finally, let's check out C3 AI reportedly cutting its workforce amid the need for cost savings. This is according to Bloomberg. Shares the company erasing gains on that news. And they did give a statement here, Julie, to Bloomberg, saying C3 AI continues to hire and fill open positions to fill our strategic areas. We currently have jobs posted for 109 open positions. Like many high-performance companies, we regularly manage out lower performance employees. So that's how they're framing it.
Yeah, I mean, I had seen some chatter around these layoffs earlier in the day, but if you're talking about cost savings specifically in a more pointed way, perhaps that's what changed the trajectory of the stock on the day. It really did turn after these headlines started to come out, after earlier having been swept up in, as it has frequently, all of the AI enthusiasm. I mean, this is a stock, I mean, the ticker is AI, for God's sake. So anytime you get, this is one of those things where, like, anytime there's bigger news on AI, this is a stock that tends to go higher no matter what's going on specifically for this particular company.
You make a good point. As every possible company on the planet tries to work AI into their marketing materials,
yeah,
you got it in your name. By the way, stock's up 150% year to date.
AI,
It's working.
it's in the name.
It's working. All right, moving on here. The ouster of Sam Altman as CEO at OpenAI, sending shockwaves through the tech world, surprising Wall Street and Silicon Valley. OpenAI has been at the center of the artificial intelligence hype, receiving billions in funding, including a multi-billion-dollar investment from Microsoft. As aftershocks of the C-suite shakeup wreaks havoc on OpenAI, we're taking a look at what this all means for Silicon Valley and future startups. Here to discuss, we have Cameron Ansari, Headline Venture partner. So Cameron, let's just start with the general news here. And listen, the headlines keep shifting here. Cameron, we're not sure exactly how we're going to end up the day, but I want to get your just take here. What did you make of the news so far? What was your take?
It's been astonishing. It's been like watching, telenovela or soap opera these last few days. This is a company that is probably one of the most influential, important companies that's emerged in the last decade or longer. And you've had 3 CEOs in the past 72 hours. So it's still unclear exactly what's happening. And it's obviously the talk of not just the tech and the venture business, but now, more broadly, all over the general news, and the general public is also interested in what's happening here. So it's been kind of a very unusual set of circumstances that's come together to have this happen. And I think a lot of it that I'm hearing, at least in the tech and venture space, is around what this says for just governance and corporate governance, and really having folks think about, hey, how are boards comprised? Who are these board members exactly? Because a lot of times that ends up being sort of an afterthought as you're putting together financing round for early stage company. It's like, oh yeah, we'll put these guys on the board. That's just how it's going to work. And then you realize that, no, these things actually do matter quite a bit.
Well, what's so interesting to me, Cameron, is that discussion has been around for a while, and we get these periodic reminders. This is a very dramatic one, to be sure, but why hasn't Silicon Valley gotten its act? This is not news, right? Why haven't they gotten their act together on some discipline when it comes to these boards?
So you think about it, I really compare this, and what this reminded me of was the situation with Uber when they were replacing Travis Kalanick, and they brought in Dara Khosrowshahi, who's been fantastic, an amazing CEO there. But that process took place over the course of many weeks, and then there was a weekend-long board meeting. They had I think a 10, 12, 15-person board with public company CEOs and professional investors, members of the founding team there. So there were a ton of folks kind of weighing in. It was a very kind of buttoned-up professional process they went through, and they found that the best answer for them was to make a change with the CEO and do that. This was a 4-person board or 5-person board if you include Sam, which is a very unusual dynamic for a business at this scale. Normally you would see something at this scale have 7, 9, 11-person board. And then the makeup of the board itself, I think Vinod Khosla put out a post today. Just because someone has a fancy title like the head of technology, center at Georgetown, whatever, that person may not have sat on a lot of private company or public company boards. And so it's unclear whether these folks that were kind of making this decision, really had kind of the purview, the perspective, and the experience to be doing so.
And Cameron, I'm interested too, just your take on what founders might take away from this. I mean, granted, Sam Altman is not your typical founder, but are there lessons learned for founders in all this drama?
Yeah, absolutely. I mean, I think the biggest lesson learned is pick your board members carefully, right, or make sure that the board composition is something that you're comfortable with going forward. And I think that typically for an early stage company, what you want to have is usually you'll have 1 or 2 of the critical kind of main investors who sit on a number of boards, who've kind of been through this movie before, have seen companies go through ups, downs, exits, fundraising events, all that sort of thing. You may have the 1 or 2 founders on the board, and then typically what you want to see is like an independent or 2, someone from industry, an experienced business veteran in the space that you're in, and that'll kind of round out a typical board, what that might look like. And so that's sort of best practice. Now, in a lot of cases, if you're starting a company and you're just raised a seed or Series A round, you're not going to go through all that process. You may just have an investor or 2 and the founder, and that's it. But again, as companies mature, and certainly this company, and I say company, I know it's a nonprofit that owns the wholly owned subsidiary that's the for-profit, but an entity of this scale at this point should have had, I think, a larger, more sophisticated board. I think you're going to see that now. And one of the other bizarre things is that the largest shareholders, again, I know it's the for-profit side, it's kind of complicated. Microsoft didn't have a seat, right? You would always expect Microsoft, Sequoia, Tiger, these folks that have large stakes in the business to have seats on the board, and they didn't in this case. So then you're going to see a bunch of changes here happening. not just at OpenAI, but I think all the cohort of companies that are similar.
The other thing I'm curious about is there is, I think, a scenario here where everybody loses their money, like where the investment they put in goes to nothing, goes to zero. So what kind of a ripple effect does that have in the industry? And is it a black eye for the firms that invested in OpenAI?
I think certainly the firms that invested in OpenAI, I imagine they probably did push for a board seat, right? But at a certain point when a company or entity is hot, it's singular, it's the best deal of the century, you sort of let that stuff go. You say, oh, fine, okay, we won't take the board seat, it's fine. I think you saw something similar happen with FTX, where I don't believe that a bunch of the investors really had board seats there because a different Sam, that founder was like, look, I don't want you guys on the board, or we only have 3 seats and that's it. And you say, okay, fine, in order to get involved with this rocket ship, I got to go along with this governance structure. But I think you're going to see the investors push back more. I think the other ripple effect it's having for sure is that all the competing companies that for a while have been sort of playing second fiddle to OpenAI, they're seeing an uptick obviously in applications for jobs. People may be leaving OpenAI. Clients that are looking to reach out and diversify away from relying on OpenAI. So Cohere, Google, Anthropic, all these other businesses that have AI capability are now going to be the beneficiary of this potentially. And it's still not, it's a huge mess, because I think today you saw that 500 of the 700 plus employees have sort of signed a petition saying they don't have faith in the board. They're probably looking for jobs elsewhere. I think you saw news that a number of the OpenAI clients have reached out to other competing solutions to use those instead of OpenAI. So it's having a real damaging effect. And I think before the end of the week, you're going to see some probably significant changes happening in OpenAI, because I don't believe that the folks like Microsoft and Sequoia and others that are invested there are going to let this just kind of go away.
Yeah. And Kevin, finally, just quickly here, we were having you on originally to just talk about the bigger environment for VCs, and then this whole thing happened. Just quickly, how do you think 2024 looks at this point? Do valuations improve? Do we start to see more exits, or do things kind of bump along here?
Well, I think you've seen in the last 6 months a real pickup in both deal activity. You saw a number of IPOs come out finally in September, October. You had Klaviyo and Instacart and Arm. It all started with Kava, the Mediterranean food company or a restaurant back in the spring. So there are a number of other folks that I think are in the pipeline that I think will start to come out in the public market. Names that have been circulated for a while, like Stripe and maybe Plaid, a company, Databricks, Intercom potentially. There are a lot of these folks that have been kind of ready or almost ready, but I think now the window may be opening for them as we head into 2024. And then M&A should pick up too. M&A has been very quiet other than private equity firms buying these sort of great SaaS names. But that's all played out too. They've all been taken out. So Coupa and Zoom, Sumo Logic and Avalara, they've all been bought, right? So by and large now, the great SaaS names that were at approachable valuations are gone. So the private equity folks don't have a lot to buy anymore. So I think you're going to have M&A picking up now that we're in kind of hopefully a more stable interest rate environment. There's more predictability, and I think the buyers feel more comfortable kind of jumping in.
All right, Cameron Ansari, thank you so much for joining the show today, Cameron.
All right, thanks so much.
We got breaking earnings news on Zoom right now. The company shares are moving higher. That's after it beat earnings estimates and came out with a fourth quarter forecast above estimates. Just to give you some of the highlights here, third quarter adjusted earnings per share $1.29, $1.10 is what analysts had been anticipating. Revenue rising 3.2% year over year to about $1.14 billion. The company said enterprise revenue rose by 7.5%. Online revenue fell by 2.4%, so more of the enterprise revenue strength that it is seeing there. And also, the company boosting its revenue estimate for the year and for the fourth quarter says that earnings per share will be $1.13 to $1.15. Analysts had been estimating $1.09. So pretty much beating across the board here, Josh.
Yeah, it's a nice pop. Listen, we all remember Zoom because during the pandemic, we were all on Zoom.
We're still on Zoom a lot.
and so you saw this it had tremendous growth, but then pandemic ended, the world changed, and granted, Zoom did change with it. They introduced, for example, new AI tools. But heading into this print, not a lot of enthusiasm. And stock was actually in the red heading into this report. In part, people on the street, I think, are on the sidelines for different reasons, but one is clearly competition. And they're just worried about what Microsoft Teams ultimately means for this company. You'll hear analysts say they even consider a kind of existential long-term risk. But at least right now, the immediate reaction is positive for the results.
I mean, if you look at the growth in the enterprise side, they saw 5% growth in the number of customers to 219,700. They talk about online average monthly churn of 3%. Again, that's on the consumer side here, but that churn is down. So, do you have a sort of like slow and steady growth situation here? Maybe. The company has worked really hard to try to come out with new products and new features. They've really played up Zoom Phone, for example. So we'll see if that continues to bear fruit for the company. But I guess one of the positives of low expectations is you can come out and beat them. And by the way, CFO Kelly Stuckelberg will be joining our morning show tomorrow to go over some of these numbers.
One question I would have for is acquisitions. M&A, that's something people do talk about with Zoom. Healthy cash pile, do they make a play in collaboration or productivity tools, right? Of course, that's also where Microsoft plays, so we'll see. It'll be interesting to watch.
Good question.
All right, coming up, Sam Altman's ousting from OpenAI causing a lot of chaos in Silicon Valley and prompting questions about safety in the space. We're going to break that down next.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Oil coming off of a wild week and prices today jumping 2% ahead of the OPEC meeting this weekend. But demand concerns have outweighed production cuts. Prices are down about 20% from last year. And it could be another bumpy ride in 2024, at least according to JP Morgan. And Yez Ferre has been following the story for us. And Yez.
Yeah, Josh, and we have seen that this year has been really volatile when it comes to oil. We saw that supply squeeze because of the production cuts from OPEC Plus and the unilateral cuts from Saudi Arabia and Russia as well. And then we've also seen the resilient demand coming from places like the U.S. But it has been flat for the year, down about 17% from the average that we saw in 2022. Now, as far as 2024, JP Morgan analysts are saying that you can expect a bit of more of the same. So JP Morgan analysts are predicting that for this year, Brent crude will average $81 per barrel, while for 2024, it will average around $83 per barrel. And then you're going to see oil ticking down about 10% in 2025. And Natasha Kaneva, the head of global commodities research at JP Morgan, wrote a note to clients, and their big reveal was what would happen in 2025 for oil. So first, let's stick with next year. Demand is expected to tick higher. You're going to see a supply increase from the non-OPEC Plus producers. And the analysts at JP Morgan are saying to keep markets balanced, OPEC Plus will have to constrain production, continue to do that. And in 2025, though, you could see a surplus of oil. You're going to have that EV shift really going into full gear, no pun intended there, and more fuel efficiency going into 2025. Now, the big question is, what will Saudi Arabia do with its unilateral cuts? Those are more than $1 billion of a barrel, 1 million barrels per day from Saudi Arabia, and what will Russia do as well? And if those were to unwind, you could see then oil prices being shifted again in 2025. And you could see in 2024, U.S. producers scaling back on drilling because of lower oil prices. As you mentioned today, we saw up more than 2% for WTI on our Wi-Fi Interactive. You're looking at Brent crude that's up almost 2%. And this is because OPEC Plus is going to be meeting on November 26th. And Reuters had reported on Friday, and you saw a tick up in oil on Friday, because that sources are saying that OPEC Plus could continue with more production cuts going into 2024. Guys?
Ines, thanks so much. Appreciate it.
Thank you.
Well, as Sam Altman's exit from OpenAI causes a shakeup in Silicon Valley, many are speculating on what this means for the broader industry, and one key concern in particular, that's safety. The release of OpenAI's latest model of ChatGPT saw major players in the tech space call for a pause in development of generative AI overall, raising concerns over its existential risks. Joining us now is Russ Newman, professor of media and technology at NYU. Thank you so much for being here. Amidst all this kerfuffle was some reporting that there was some concern that the commercialization of AI at OpenAI was proceeding too quickly, maybe was raising some safety concerns. What do you think is going on here, Russ? Do you think the industry is being careful enough?
Well, I think we can speculate there were 4 issues that could have been intertwined in the boardroom dramatics out on 18th Street in San Francisco. The first is the issue of safety, and whether pausing would make any sense. But my view is that if you sort of stop or slow down, that's not going to make any difference. You got to put more energy into finding AI systems that can do the monitoring, because humans can't keep up with these large-scale systems. The second thing is OpenAI was supposed to be open source, and it's not clear whether it makes any sense to have an open source program when you have 1.7 trillion different parameters. If you can open that up, nobody can make sense of that. So if it's the concept of open source in this day and age makes a lot less sense. And the third thing is the notion of commercialization of for-profit, not-for-profit. It seems to me we wouldn't have seen what's going on if there wasn't the investment from Microsoft to make it possible. The fourth possible issue that would generate the boardroom drama is simply the personalities. So my take on it is all four of those potential issues are sort of non-issues, because if you generate a company based on selling your access to your foundational AI model and it's not safe, that's not economic either. So there's a lot of incentive to keep things safe economically.
And Russ, what is the biggest near-term risk when it comes to AI that you see?
There was a study at Stanford where they took something like $400 to $500, and with that amount could tune a system and reschedule it, reorganize the system so that preventions that were built into the AI system were no longer at play. So it's just going to be a wild west. We got to get used to this. If there are malicious players out there, it's very difficult to say, well, my foundational model will prevent that, because the tuning of these systems is going to reopen up all those questions all over again.
Does what has happened over the past few days change this equation at all?
It changes it for the personalities involved in OpenAI, but I'm guessing it's going to be about a dozen foundational models paid for in large part by the large tech players, and that all of the action is going to be on finding fine-tuned specialized versions of those foundation models. And that's good news. That means there's going to be many dozens of players working these models. GPT-4 cost $100 million and took 100 days and 25,000 Nvidia chips to build it. That means that setting up a foundation model is going to take a big investment. All the action is going to be on fine-tuning those models for specialized purposes.
And Russ, the fact that it is such big players and it is so expensive to build these models, does that imply that they will be more careful, if for no other reason than fear of liability, as they move forward?
Yeah, I think I think the whole concept that if somebody was complaining, you guys are for profit, you're talking to Microsoft too soon, the notion that a not for profit would have different incentives, I think is naive.
And Russ, what in your opinion is the proper role of regulators when it comes to this technology? And do you trust, Russ, and have confidence in American lawmakers? I see you're laughing already. Maybe you know where I'm going, but do you have trust and confidence, Russ, in American lawmakers and regulators? Do they have the insight, the experience, frankly, the tech chops to know how to regulate this technology smartly, responsibly, effectively?
AI is basically applied mathematics. You can't regulate mathematics. The one-liner I've been using is trying to regulate AI is like trying to nail Jell-O to the wall. I was surprised by Altman's appeal to say, let's have some regulatory review of these issues. The president's executive order was very careful not to recommend a new regulatory agency. And I hope that becomes the posture of all the future administrations, because I think it's a sorry, it's going to be an unsuccessful, even if well-intended effort on the part of the federal government to regulate.
And so, I guess from a developmental perspective, what do we make of, does it matter if Altman stays at OpenAI? Does it matter if he goes to Microsoft in terms of just where generational AI goes going forward?
Well, with the news that 700 of 770 employees want some change, my guess is the drama will be over fairly quickly, and we'll see a reorganized OpenAI as a major player. nobody quite understood how, with Microsoft's very substantial investment in OpenAI, they weren't more involved in the future of that enterprise. My guess is we'll see some kind of a compromise, whether Sam and Greg are working for Microsoft. My guess is if they don't get cooperating, they'll take the building across this 18th Street and look at each other through the windows, and we'll see a lot of progress on both sides of 18th Street.
Russ, finally, I mentioned that letter that a lot of people signed that raising concerns about this sort of existential threat, potentially, that AI can pose. You know, Elon Musk has brought that up. Jeffrey Hinton has brought that up. Sam Altman, I think, signed on to that very letter. I know you didn't sign that letter. Are you concerned that, you know, there's existential threat to humanity from the development of AI?
I am. I think we need to take it seriously. These are very bright young men and women. And when they said, let's stop for 6 months, they knew we wouldn't stop. They knew it wasn't possible. They just wanted to find a way to draw our attention. And I think that attention is well spent. What we got to do is work harder, work faster on keeping these things under control. And I think the more investment, the better.
Russ Newman, great to get your perspective on this. Thanks so much for taking some time to spend with us.
Thank you.
Coming up, we've got more market coverage and Yahoo Finance after the break.
Well, are US consumers flocking to Chinese e-commerce for deals this holiday season? Well, on TikTok, hauls from the fairly new Chinese e-commerce brand Temu have picked up where the Shein craze left off. Consumers boast about getting huge deals on products that they may normally find on Amazon or in stores for higher prices. On Temu, you can find backpacks for $3, socks for 80 cents, and even smartwatches for $10. Now, as the consumer gets more cautious, could Amazon and Walmart be losing share to these low-cost Chinese retailers? Let's bring in Reuters reporter Ariana McElmore for more on this. So, Ariana, break this down for us. Give us some context here. How are they doing market share-wise, these Chinese e-tailers and retailers versus the Amazons and the Walmarts?
Absolutely. So when you have Shein and Temu, they're really great for stocking stuffers. Think makeup, think toys and smaller electronics, things that are under $20. But for Amazon and Walmart shoppers, they're looking for TVs, they're looking for iPhones, they're looking for tablets. So when it comes to competition between the two, those consumers are looking for totally different things. And at the end of the week, we have Black Friday. So there's a lot more time between getting your presents and getting them under the tree. Now, for those last minute shoppers, you're going to see those shoppers go to Amazon because, they're banking on that 1 day and 2 day shipping, even though Shein and Temu shoppers may be looking for those lower prices. So it's really all about a give and take.
It's true, because especially when you think about holiday shopping, that timing very important, especially if you left something till the last minute. Now, we were showing some TikTok clips there. Talk about the marketing around the holidays when it comes to how successful Shein and Temu have been.
So Shein and Temu, they know their consumer, they know it's teenagers, they know it's Gen Z. So you'll see a lot of their marketing on TikTok. You'll see a lot of their marketing on social media. Shein has also made a push for marketing in Times Square. They did a pop-up earlier in November, and Shein is known for doing pop-ups across the country. So marketing is a big play. When it comes to Walmart and Amazon, you'll see a lot of Walmart marketing, on TV, on your streaming channels. Amazon has been huge on marketing within its app and on its streaming platform. So again, each platform knows who their audience is. And when it comes to Temu and Shein, they know that younger consumers just don't have as much money as, maybe their parents. So that's where they're meeting their customers.
And I'm certainly getting lots of links from my daughter about things that she wants from Shein and Temu and other things. And I'm just like, we'll see. Slow your roll a little. But I want to talk about something that we've seen, which is Shein's, now we're seeing Shein in Forever 21 stores. Talk about the strategy there and how that really helps Forever 21 as they perhaps try and capitalize on some of the momentum from Shein as well.
So I think that is a really interesting play, right? Like, we haven't heard anything from Forever 21 for years. It was huge when I was in college, huge when I was in high school. But after that, you didn't really hear anything about it. So now that they have this partnership with Shein and they're getting more eyes on the platform and in the stores, they're really hoping to get a boost from this partnership. Now, it remains to be seen on whether this is going to work or not, right? You also see Shein acquiring Misguided, which was also very popular, in 2013, 2014. And so you see Shein taking all of this market share from these other fast fashion companies. And it's going to be really interesting to see, if Gen Z kind of pivots to the Forever 21s or the Misguideds. I think that Shein's going to have a long way to go if it wants to beat the likes of Amazon. For example, Shein, between January and September, was able to rake in $24 billion. Now, for Amazon, their online revenue sales were $53 billion. So like I said, Shein has a long way to go if it wants to beat the likes of Amazon.
And I want to ask about Amazon excluding Temu from its competitive price checks. Talk about the strategy there, because a lot of people are wondering about, are the standards the same? Should they be included in the algorithm in the same way?
So for Amazon, they are worried about the quality of goods. They're worried about counterfeit goods. And for them, their position is that they don't want to compare their merchandise to something that may not be up to par for their standards. Now, it's up to the consumer to say if that's fair or not. But I think for Amazon, that's going to keep a lot of their merchandise still on their platform without having to worry about, removing some of their marketplace sellers who may be getting their products compared to, the Temus and the Sheins.
True. Plus, at the end of the day, you always have to check the reviews because,
right.
no matter where you're shopping, it's the reviews that'll really tell you what you're actually getting for your money. Appreciate you taking the time to join us. Reuters reporter Ariana McElmore, thank you so much.
Thank you.
Take a look at shares of Fisker right now. The stock is sliding about 3% on the day. The Wall Street Journal reporting the EV maker is losing its second chief accounting officer in less than a month. And this coming, Julie, as we know, this is an EV startup that's faced its share of challenges and headwinds. Recently reported Q3 results that missed at least the street's expectations. The stock's been crushed.
Yeah, and the reason the company had to delay results when the last chief accounting officer left, it's had a lot of supply chain issues in getting the vehicles to where they need to be. And it just seems to illustrate the difficulty for especially some of these high-end EV startups. I think of a Lucid as well, although it hasn't had as much trouble as Fisker. It actually has more cars on the road, but nonetheless, it just, these guys seem to be collectively having some different struggles here.
Yeah, I mean, we talk a lot too just about broadly the struggles, not struggles, Macy, but the cooling the EV market has really seen. Talked about, we've had different analysts come on who talk about the way that even the Teslas of the world's cutting prices, inventories piling up, and different reasons for that and how maybe you try to jumpstart growth in that market.
Right.
Is it about price? Is it about rates? What's the move?
Well, on the flip side, though, when you're looking at a Fisker or a Lucid or Polestar, for example, they're operating at a different level of the market, right? It's not a mass product in the same way that some of the other automakers are trying to put out EVs. So unclear whether they'll be subject to the same sort of overall EV market cooling if they indeed are sort of appealing to a luxury customer.
Yeah, we're watching. It gets tougher as your competitors keep slashing prices. Obviously, it does put more pressure on you.
Yeah, definitely. All right, coming up, a big sale on streaming. We dig into Max's Black Friday discount and the streamers' effort to gain subscribers. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President Investors Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Welcome to Yahoo Finance's group chat. I'm Alexandra Canal, joined by Josh Schaefer and Pras Subramanian, and we are starting with a milestone for Disney boss Bob Iger, because it is exactly 1 year to the day that he came back to run the company once again. I remember it like it was yesterday. It was a Sunday night around 9:30 p.m. Took the media world and really Wall Street by complete surprise. Now, if we take a look at the stock since Bob Iger has taken over the company, it's up about 3.5%. That is far underperforming the S&P 500, which is up more than 14.5% over that same time period. And yes, Disney has had a lot of struggles, particularly when it comes to its film division. It's still not profitable with streaming. We have issues with the linear side of the business. But if you think about what Bob Iger has done in a span of just 1 year, we finally have an answer on Hulu. He's going to buy that 33% stake from Comcast. He's doubled down on ESPN, taking that direct to consumer. He said he's open to selling off non-core assets like the linear side of the business. So I think all in all, he's done a lot to set this company up for really the next frontier of the streaming wars, the next frontier for media, because this is something that really all these companies are going through right now.
Yeah, I mean, it's been a year since the announcement, but not really a year since he got to start impacting the company, right? And really even, you think about how long that takes. I think if you look at Disney stock over the last month or so, or maybe even 3 months, since their most recent reporting, it's done pretty well, if I remember correctly, and that's really because you're starting to get those answers, like you said. I think people are starting to, okay, it was, what does Iger want to do? And then 6 to 9 months later, is it starting to work? And you're starting to see it work a little bit. Of course, still questions with ESPN and what happens there, et cetera, and plenty of questions about streaming eventually getting to profitability. But I think we're starting to see some of the things he's talked about come to fruition and at least start coming together.
You know, it's kind of, I was surprised to hear that year mark, because it feels like it's been much longer that he came back. Yeah. Only a year ago, Bob Chapek was still there, right? And I think, Ali, you probably know more about this than I do, but the stock probably popped when Iger came back, right? Because there's clearly the right move at the time as the company goes in transition. But, you know, I was just thinking about how, you know, a lot had happened before he even left, right? The first time was he made a lot of big acquisitions, Marvel, Star Wars, Lucasfilm kind of franchise, and spent a lot of money. Those movies did well, the franchises did well, but a little bit of petering off near the end as people kind of got fatigued with those franchises. And you talk about selling off assets. These are the things that he considered sacrosanct, right? ABC, the linear network, right? The cable, other channels. Also talking about ESPN. I mean, that potentially being spun off. It's kind of crazy to hear about, but maybe he's sort of thinking about the fact that times are changing and we got to revamp the business.
Yeah, and when streaming first came to market, when Disney Plus first came to market, they needed content. So there was a lot of overproduction, I think, when it comes to those Marvel series, the Star Wars series, and that trickled down over into the film side of the business. And Bob Iger has admitted, you know, we've lost the attention of the consumer. We need to really pull back on some of that content in order to make sure we have quality over quantity. That's something that he stressed on several earnings calls. He is going to be hosting a town hall next week where we should be getting a little more clarity on the future of his strategy.
I want to take a look at one of Bob Iger's competitors, because I love this idea coming out for Black Friday, right? So when you take a look at this story coming out of Max today, Max is going to be offering a Black Friday deal, 70% off for the first 6 months. Really a big story for Warner Brothers Discovery here to try and get more subscribers in, right? So you go from a price of $9.99 to $2.99. This is one of the first Black Friday deals I can remember in streaming as a whole. I don't know if any other come to mind for you, Allie, but this sort of sticks out as an interesting moment in the business when we really think about, to me, 2023, the streaming story has been a lot about price increases and a lot about trying to get people to pay more. Well, now Mac's saying, we just want to get...
crackdown.
We just want to get you on the platform, actually, and then you're going to love it so much that you're going to pay full price in 6 months. But I love them getting into Black Friday. I think it's a great idea.
I mean, $3 a month, that's a pretty good deal. I mean, it's only for 6 months.
With ads too, right?
With ads. So that's a big point that I want to stress is that a lot of these streaming companies want you to sign up for their ad-supported tiers.
Yeah.
That's why they're pricing the premium plans higher. They've been pretty much keeping those ad-supported plans stagnant across the board while raising the prices of those ad-free plans because they want to draw consumers to ad-supported. They want that to be an attractive place where ad buyers can go. And over time, the hope is that the technology can improve, and then this is a really quality experience for the consumer. But if you take a look at their last earnings report, Warner Brothers Discovery shed 700,000 subscribers. So they're really trying to get more subscribers on the platform.
Yeah, and we talked about, ad loads and things like that, and they want to have that minimal ad load compared to their competitors, and I think that's a way to make it okay to have the ad-supported product. I can't go ad. I can't do it.
No,
I've been paying for the non-ad stuff.
We're going to get an argument about this.
I'm paying for the non-ad stuff. I just find it so disruptive. But if you mentioned a different use case where you're like, I just want something on the background. I don't care if the ad comes on. I'll watch the TV. I'll pay attention to it somewhat. Who cares? I guess there's different ways to look at it. But I just, for some reason, I'm like, I got to pay. It's got to be a huge premium for me to pay to be like, I'll watch some ads.
Well, 3 to 4 minute ad load for Warner Brothers Discovery, about
for
4 minutes
hour.
for Netflix
per hour.
I
You
mean,
can put up with it.
That's not that bad. I'm all about the ad-supported life.
Not this guy, though. This guy's flying first class. He's flying first class, and he can't have any ads in there.
That's what we call him.
We do. Well, you might be watching some TV at home, and the subject of Thanksgiving is coming up here. But next week is going to be the busiest ever when it comes to travel. I meant to say you might be watching some TV with your family and friends. But anyway, TSA says the period starting last Friday and through next Tuesday after Thanksgiving, we'll see a record 30 million travelers at airports. It's going to be slammed planes, trains, automobile style, that security line at airport terminals. Guys, the airlines have been telling people that expect busy time ahead. They've been slamming people in these planes for months now. What do you think? I mean, remember last year there was a Southwest fiasco. If you have a weather fiasco or a tech fiasco, it's going to be madness.
Yeah.
It seems like some of the issues haven't fully gone away, right? As far as just it's not that smooth of a process anymore. It never feels like it is at the airports, and just like the simple delays seem to sort of compound these days. And I'm flying tomorrow morning, so
Godspeed.
I'll give you the update. You sent this story this morning in the headline from TSA, and I didn't feel too great about it. I mean, if it's going to be record travel, you think it's probably going to be a mess. But I guess I'll tell you guys next Monday how that actually goes for me.
Yeah, I think it's been an interesting few years for the airlines, and you're seeing a lot of them start to change their frequent flyer and loyalty programs. Delta, American Airlines, British Airways, they're making it a little tougher on the consumer. They're really cracking down on some of those prices because they're trying to make up for what happened during the pandemic. We'll see if that could maybe correct itself moving forward.
Yeah, I want to quickly add that Pete Buttigieg just tweeted out today about this, saying, hey, we've put in rules in place. If the airline counts as your flight and it's not your fault, you got hotel, you have meal vouchers. Make sure you ask for it because they know how much heat they took last year when people wanted to blame the government too for this.
Right.
That'll be a story we're following all week long here, but coming up, we're going to bring you what to watch tomorrow. We're going to dive into the stories you'll need to know heading into your Tuesday next.
We end today with where we began, talking about OpenAI. As the future of the entity becomes increasingly uncertain as employees threaten to quit unless the board resigns. And 3 developments that we're watching here. Firstly, Salesforce CEO Mark Benioff looking to capitalize on the drama he posted on X earlier and effectively said, come work for us. Because in case you can't read that, he said Salesforce will match any OpenAI researcher who has tendered their resignation, full cash, equity, OTE, to immediately join our Salesforce Einstein trusted AI. The point is, he's saying, send me your resumes, we will hire you. So that's one development. Another development is, we don't know what's going on. Is Sam Altman actually leaving OpenAI to work at Microsoft? Is he staying? It's unclear at this point. There have been some cryptic tweets on his part where he talks about the partnership between he and Microsoft, but it doesn't feel like we've gotten confirmation yet.
No, I mean, right now, we really don't know where things stand. You just have a lot of different headlines. Maybe Sam Altman winds up at Microsoft. Maybe he doesn't. When you have hundreds of employees at OpenAI saying, listen, we are ready to jump ship, that is a tremendous amount of pressure on the board. So not only we don't know where Sam Altman's headed, you don't know where OpenAI is headed.
Or where the board is headed of the company.
Does Sam Altman go back to OpenAI, try to kind of right the ship somehow? Or do hundreds of OpenAI employees leave, at which point, I don't know, is it liquidated? Does it revert back to being a nonprofit? Not sure.
Unclear. And then another interesting piece of that just again speaks to the turmoil and the uncertainty is, remember, first OpenAI said, okay, acting CEO is going to be Mira Murati, who's the CTO. Then it said, no, the interim CEO is going to be Emmett Shear, who most recently was the head of Twitch. Well, today, in what feels like almost like a political disinfo campaign, there have been some stories coming out about him, and they do seem to be legitimate, that he has tweeted criticism of Microsoft. He has a history of his thoughts on sexuality. I'll leave people to read them themselves. But it feels like an attempt to focus on the negative here, more negative news flow for that OpenAI board.
There's a lot of headlines. Somehow I think we're going to be discussing it again tomorrow.
Yeah, that's a good guess.
It's just a bet.
That's the only certainty we have at this point.
That's it. All right, let's take a look at what to watch on Tuesday. It's a busy day for earnings ahead of the open with retail in focus. Kohl's, Lowe's, Best Buy, and Abercrombie & Fitch are the key names to watch. And it's been a mixed picture, we know, for this sector, especially heading into the key holiday season. Other companies have raised concerns about soft spending in the current quarter. And then after the close, it's all about Nvidia. Shares of the chip giant closing at an all-time high heading into tomorrow's results. Stock has already tripled this year, and Nvidia has beat analyst expectations for 19 of the last 20 quarters. And because of that consistency, it's the outlook that Wall Street is really watching closely here. The company facing some concerns about regulation after the U.S. government limited chip exports to China. Other companies reporting after close include HP Inc. and Nordstrom. And then on the economic calendar, we're going to get some existing home sales and the Fed minutes.
Ooh, busy. All right, that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell, and probably some OpenAI. Have a good night.